I built a relative valuation model in Excel. If you want a copy, just email me. But make sure to watch the video so you know how to fill in everything. I want to value Coca-Cola, ticker KO. I'm going to compare the company to Keurig Dr. Pepper and Pepsi. You first want to get the share price. That's $64.08. I pulled everything from Yahoo Finance. If you just go to Yahoo Finance, type in the ticker KO, and on the left section, click on statistics. Everything you need is in this area. So the current stock price, $64.08, you just copy that and you put it into your Excel file. Then the shares outstanding, just scroll down a little and you'll see shares outstanding, 4.31 billion. Make sure you type in the entire number. I formatted it so everything's in millions so it's easier to see. I made it easy where you just have to type in 4.31 and then it's multiplied by a billion. So if it was 10 billion, you just type in 10 right here and hit enter. That's 10 billion, even though it looks like 10,000 because of formatting. So change that to 4.31. The market cap is calculated, so don't touch that. Only change things in blue. Next is net debt. That's total debt minus cash. Let's go back to Yahoo Finance. Scroll down to the balance sheet section. Total debt, 47.12. Cash, 18.16. So hit F2. Just type in 47.12 minus 18.16. And that's it, because that's multiplied by a billion. Enterprise value is calculated. Enterprise value is market cap plus net debt. Now we need the revenue. Let's go back to Yahoo Finance. Go to income statement, 46.37. Let's fix this. It should be 46.37. EBITDA. Let's go back to Yahoo Finance. EBITDA, 14.83 billion. So copy that and just paste in the 14.83. Now it's 14.8 billion. Net income, let's go back to Yahoo Finance. Net income, 10.41. Let's copy that. Just paste in 10.41 times a billion. And do the same thing for the other tickers. Keurig Dr. Pepper, Pepsi. And that's all you have to input. Everything else is calculated. Coke's EV over revenue is 6.6. And you can see the calculation. That's enterprise value, 305 billion over revenue, 46 billion. EV over EBITDA, that's enterprise value over EBITDA. And PE, which is market cap over net income. So for the three companies, EV over revenue, 6.6, 4.0, 2.8. You could take the average. I like to take the median. The median is 4. That's the middle number. The reason I don't use the average is because sometimes there's a really big outlier. Like for instance, you'll see a PE of 800. And then if this was average, I'll change it to average. The average is 281, which is just crazy. The EV over revenue, the median is Keurig Dr. Pepper, 4.0. For EV over EBITDA, the median is Pepsi, 15. And for PE, the median is Pepsi, 23.9. It doesn't matter how many companies there are, whether it's 3 or 50, you want to use the median to value your company. So now we want to get the implied enterprise value for Coca-Cola. The way we do that is we take their revenue times the median EV over revenue times the 4.0. So we're assuming Coke has the median EV over revenue, the 4.0. So their enterprise value would be 186 billion. And we calculate the implied enterprise value for EV over EBITDA and PE. So their implied enterprise value should be between 186 billion and 278 billion. We have to minus out the net debt. We know Coke's net debt is 29 billion. 29 billion equals 47 billion of debt minus 18 billion of cash. So we're assuming they would use all the cash to pay down the debt. And if they did that, they would still have 29 billion of debt left over. So that's why we minus out the 29 billion. So their implied market value is 157 billion. Their shares outstanding is 4.3 billion, which we plugged in right here. Their implied stock price is $36 on the low side, $58 on the high side. So now we look at Coke to see if they trade within that range. They trade above that. They're at 64. So according to this model, they're overvalued and we would not buy the stock. Because there's always going to be some companies that are overvalued when you do this calculation and some companies that are undervalued. The purpose of the relative valuation model is to combine all the companies and try to equalize them. Because you can't look at the three companies and say who has the most revenue. It's Pepsi, so Pepsi must be the best company, and Dr. Pepper has the least revenue, so Dr. Pepper is the worst company. We should only buy Pepsi. You can't do that. Pepsi may be really overvalued or really undervalued. We have to look at multiple things to figure that out. The PE is a good metric because that does equalize these companies. It takes their entire market cap over their net income, and it shows you how many times their market cap is trading above their net income. Coca-Cola is trading at 26 times earnings, Dr. Pepper 20 times earnings, and Pepsi 24 times earnings. So just based on the PE, Dr. Pepper seems like the best value. But there's more than just a PE, as you probably know. So this is a good alternative to the discounted cash flow model. But you never want to rely on just one thing. This is just one tool in your entire toolbox. You should use a DCF and this, and you should look at other things like the macro environment. The good thing about this is it's just inputs. There's no guesswork. The DCF, there's a little guesswork because you have to predict the future free cash flows. You also have to predict the WACC sometimes. So this is more straightforward than the DCF. This approach is used for real estate. If you're going to buy a home and say the home was listed for $800,000, the way you would figure out if that was a good deal or bad deal, you would look at similar homes in that neighborhood. If you saw a pretty similar home that sold for $700,000, then the home you're looking at for $800,000 is overvalued. But if you saw similar homes that sold for $1 million, then the home you're looking at for $800,000 is undervalued. It's a good deal. So just some notes on the relative valuation model. The purpose of it is to value a company by comparing it to its peers. Some industries that's easy to do, others can be challenging. Some companies are really unique and don't have many competitors. Other companies are not too unique and have a lot of competitors. You can use different metrics for a relative valuation model, but the most common metrics are EV over revenue, EV over EBITDA, and PE, because your goal is to make the companies equal so they're on the same playing field to compare them. Because it's really hard to compare Apple, a company with over 3 trillion market cap, to a company with 1 billion market cap. Of course, Apple's going to have so much more revenue and cash flow than a smaller company. That's why you use price multiples to try to compare them. The idea behind the relative valuation model is if similar companies are trading at 10x earnings, for example, then you're making the assumption that the company you're valuing should also be trading at 10x earnings. Because when Tesla and Amazon were trading at 500 times earnings or 100 times revenue, you know a company can't trade at those levels forever, maybe for a few years, but eventually they revert to the mean. Because you can't grow at a 50% clip forever. At some point, you'll start growing at a modest rate, like 5, 10, maybe 15%. So feel free to email me and I could send you this model for free. But please try to watch the video several times. It'll help the algorithm. And you could always ask me a question. Either comment here or email me. I'm happy to help.